Hello everyone, welcome to this new video of the Baguette Investor, where today we're going to talk about something different. Rather than screeners, we're going to talk about risk management. This video will be an introduction to risk management. So what is risk management? If you never heard about it, it's simply how you manage the possibilities of you losing money in the markets. There are people who just don't care about the risk and do really bad things and end up with their account blown up, hashtag Wall Street bets. And there are the profitable traders who simply manage their risk according to the market psychology, if you're a technical analysis trader as I am, and thus manage to get away from the big crashes or the big, what we call volatility. Volatility is how the prices move according to their average price. You've seen volatility if you've been here in March, for example, when the COVID crisis started hitting the Western world, where everything was crashing 60% on cryptos and 25 or 30% on stocks. So this chart will help you understand a little bit one risk management strategy, and we're just going to start seeing in this video. So you have your trade, which is a bull market that we can see on this chart, a correction that establishes a resistance. We break through the resistance, so I think I'm gonna enter a trade. So I enter the trade on the white line, which is labeled PRU, as you can see, PRU on the right. It's the short name for average price in French. So basically, this is my average price at which I bought this trade. So it's the trade on WingK Tether US. My stop loss is called R-1, as you can see right here. It's R-1. And the level above my stop loss is R1. For you to understand what R1R is, it's simply what we call a unit of risk. So the distance between that space and that space, as you can see if I copy, is the same. So if the average price here and the actual price goes down to the red line, I get stopped from the trade, which means I'm taken out and take a controlled loss, which in my case, in that trade, would be 2% of my capital. So if it goes down and touches the red line, I lose 2% of my capital. If it raises to the first white line, called R1 right here where my mouse is, I'm making 2%, R2 I'm making 4%, and R3 I'm making 6%. Great, you're following me. So in that way, you are using a stop loss and you are controlling your loss. And what I do if the price reaches my R1, which is here, is that I cancel my stop loss that is at the R-1, and I set my stop loss to the average price. So in that case, when this trade is going to meet the R1, I'm going to take my stop loss, which is here, and set it at my entry price. So if you understood what I said, it means that if the price gets down again, I'm losing here 0 because the price is at my entry price. So I'm not making any money, but I'm losing money. This is a risk management you can use for range markets, for example. Or why do I do that? It's because once your trade is the risk is cancelled on your trade, let's say, you can open a new position and always have the same risk, because I do not open 1000 position at one time. Maybe you're gonna open, what I do is I open 4 risky positions and wait for the moment where I raise my stop loss to my entry level, so the trade is no longer risky. I just did that on that trade on Dusk, where There was my R1, which was over here, and as soon as we raised, my stop loss was over here, and I raised it up to my entry price. And thus, as you can see, I have my profiting trades, my risk off trades, and my risk on. And my goal is to put as much risk on trades in the risk off zone so I can take positions. And as soon as I've taken positions, they're going to start giving me profits if we're in a very, very bullish market. So I hope you understood this kind of risk management. And the third step of this risk management is when the price raises to the R1, I raise the stop loss to the entry level. That I hope you understood. And when it goes to the R3, I'm going to close 50% of the position to cash in the gains of 50% of the position. I lock in 50% of the profits and let the other 50% of the position run, and I follow all the trend. That way there are profits locked on that trade, and if the market crashes tomorrow when I wake up, I will still have made profits, locked profits, and protect my account, because what matters is the protection of the capital. So this is my swing trading strategy, but I have another one which is very, very popular, especially on small caps. It's just selling at the double. Very, very simple. You basically refund yourself. So I'm going to write something. Let's say you bought, I don't know, 10 shares. 10 shares equals $100. And now your 10 shares equal $200. So what I do is I sell 5 shares, get my $100 back. I invested $100. Now I sell 5 shares out of 10 to get my $100 back. In that way, I got a refund. Imagine you bought an iPhone. A dude comes in and tells you, I refund your iPhone. You would say yes. So now you can break your iPhone. You will no longer be sad because you have the money to buy another one. It's exactly the same. Doing that, I cancel my risk and I refund myself, so I do not take any more risk. And that's what I did on that thing, which is called DBC BTC pair on the Huobi exchange. I bought here that candle and sold half here. In that way, I got a refund from that trade, and now I'm risk-free, ready to ride all the trend. So these are 2 risk management, very intro. This is a small introduction to risk management. I hope I was not too complicated. If you found this interesting, please subscribe to the Baguette Investor channel. I will make more videos, and maybe I will make a sequel to that video just on Friday. So I will give a little more details about what I do. Thank you very much for watching. If you watched till the end, you're very brave, because this is very, very technical and complicated stuff. Thank you for watching. Follow me on Twitter, follow me on YouTube, leave a like, and goodbye.